morning, everyone, and welcome. My name is Yasmin, a transfer pricing director at MHA. I have over 18 years of experience in transfer pricing field. Today's session is designed to provide you with a short, concise summary for you to consider in managing your TP affairs. So to begin with, under the Finance Bill 2526, a range of reforms to the UK TP legislation was enacted. Most of these changes took effect beginning of this year. One of the key changes is the simplification and modernization of the rules. The legislation updated several areas, including participation condition, the treatment of intangibles, and the way financial transactions are addressed. And these updates are intended to clarify the law, align it more closely with OECD principles, and reduce uncertainty for businesses. The UK reforms also introduced a general exemption for UK to UK transfer pricing, where both parties are subject to the same corporate tax regime. And this is a very welcome change. This basically reduces your compliance burden for purely domestic arrangement, which historically in the past would have required you to prepare certain analysis under transfer pricing rules, despite posing limited tax risk. Another major measure is the repeal of diverted profit tax as a standalone regime. Now, this has now been transposed into the main corporate tax framework under a new concept called Unassessed Transfer Pricing Profits, UTPP. Under UTPP, a higher corporate tax rate would apply, typically at 6% above the corporate tax rate. This brings greater consistency to how profit shifting risks are addressed in our tax system. So alongside all these substantive legal changes, HMRC has very helpfully updated its internal guidance to help us navigate the new regime. Draft chapters of the manual now outline how the rules and provisions are to be interpreted and applied. This gives us basically a hint of how HMRC expects us to conduct our documentation, risk assessments, and compliance. Now, finally, although not yet in force, HMRC has introduced a new reporting requirement known as the International Control Transaction Schedule, ICTS. This will now require multinationals with significant cross-border related party transactions to file certain detailed information in a standardized format. This will help HMRC basically to risk profile and target audits more efficiently. This form is expected to take effect from beginning of next year, and its draft regulation will be consulted spring this year. This is the first compulsory submission, unlike the master file and local file. So where does this leave us? The recent changes are not just technical. They basically affect almost every part of your transfer pricing life cycle. So at the planning and policy design stage, the modernized TP rules put greater emphasis on accurately delineating your transactions, value chain analysis, and the identification of where key decisions making and control actually sit. In practical terms, the policies can no longer be high level or generic. They need to clearly reflect how your business really operates, particularly for things like intangibles, financial transactions, and centralized service models. The transfer pricing policy design now needs stronger input from many stakeholders within your firm. This includes tax, finance, it could be the C-suite or the front office teams. On implementation, the changes increase the importance of consistency. HMRC's updated guidance signal a strong focus on whether your pricing outcomes actually match the stated policy, not just on paper, but in the numbers reported in your accounts. Now, this means that you must now ensure your systems, intercompany agreements, and month-end processes are all aligned with the transfer pricing policy. Any disconnect between the two, the policy and the results, is more likely to be identified under this increasingly data-driven risk assessment approach. The impact on documentation is huge. While the UK has long required transfer pricing documentation, the reform raised expectation around the quality and depth, rather than introducing a brand new format. Similar to PDCF, HMRC now expects clearer explanation on certain areas, like value creation, functional profiles, and pricing rationale. This is particularly important where profits are material or outcome sits outside your benchmark ranges. The emphasis is now shifting more from purely just having documentation to having documentation that actually tells a convincing story. As such, your reports and policies should be reviewed and updated in a contemporaneous manner. This will help manage potential recharacterization risk during an audit. This also applies to management expense recharges, where HMRC is increasingly paying more attention to. Now, during the reporting stage, the future introduction of ICTS represents a step change. The development effectively embeds transfer pricing into your annual tax return process. Any errors, inconsistencies, or weak positions will be visible to HMRC earlier, meaning any issues are more likely to be flagged before an inquiry even begins. Now, finally, at the audit and dispute management stage, the repeal of DPT as a standalone regime and its replacement with UTPP changes the dynamics of disputes. The level of scrutiny is not reduced. Instead, it directly integrates profit diversion risk into your transfer pricing inquiries. So, to summarize, the recent UK TP changes reinforce a clear message. Transfer pricing is no longer just a year-end compliance exercise. It is a continuous life cycle where decisions made at the planning stage directly affect your reporting outcomes and audit risk later on. Businesses that manage transfer pricing end-to-end with strong governance, aligned system, and clear documentation will far better place in the new UK regime. Thank you for your time. I'm happy to take any questions later or after the session separately. Back to you, Chris.
Fantastic. Thanks, Yasmin. I think, building on Scott's session earlier, R&D was a huge focus area for HMRC for a very long time, and what we're hearing from senior people at HMRC is very much international tax and transfer pricing are squarely in the focus area, and they're building up specialist teams to challenge more on that front. So please do make sure you're ahead of the curve, robustly document everything that's done, and have a good defence, because it's much easier to right the ship beforehand rather than after HMRC have started asking some very difficult questions.